against all your hope, then it has a meaningful impact on a portfolio. The other big problem of Bitcoin is it is still heavily influenced by leverage.
Before we go any further, think back to the video we just watched. The one that hinted at institutions quietly positioning before the crowd notices. That video wasn't meant to excite you. It was meant to wake you up. Because what we're about to talk about fits perfectly into that same pattern. Here's the strange part. BlackRock doesn't announce plans the way crypto Twitter expects. There's no dramatic reveal, no bold promise about price, no loud endorsement of any single token. Instead, they move through structure, through frameworks, through systems that look boring until you realize how much power sits behind them. So when people ask, what is BlackRock's secret plan for XLM? The real answer isn't a single deal or partnership. It's positioning. BlackRock's entire business is built on one thing above all else: controlling exposure to systems that will still function decades from now. They don't chase volatility. They absorb it. They don't gamble on narratives. They build around inevitabilities.
One day we want to do more things, and tokenization is something one day we want to get into. And that has taken many, many years to happen. But if you look at their progression the last couple of years, they've, bought a custody business, so they do custody now. They have a prime brokerage business, and they just recently launched their own stablecoin. So it's a natural.
And global payments are one of those inevitabilities. Right now, the traditional financial system is under pressure from every direction. Cross-border payments are slow, expensive, fragmented, and increasingly incompatible with a digital-first global economy. Every bank knows this. Every regulator knows this. And firms like BlackRock know something else too. Whoever helps solve this problem doesn't just win market share. They become infrastructure. That's where XLM enters the picture. Not as a meme, not as a speculative bet, but as a protocol designed, from the beginning, to move value across borders efficiently, cheaply, and within regulatory frameworks. Stellar was never built to compete with Bitcoin's store value narrative. It was built to connect financial systems that don't naturally talk to each other. That matters more to institutions than most retail investors realize. BlackRock doesn't need XLM to be exciting. They need it to work, quietly, reliably, at scale. And here's the part most people miss. BlackRock's influence doesn't come from holding tokens. It comes from shaping the environment in which assets are used. Through funds, through custody solutions, through relationships with governments, banks, and regulators. When BlackRock moves into digital assets, they don't ask, what will retail buy next? They ask, what systems will institutions need access to once regulation solidifies? That question naturally leads to networks that are already designed to operate within compliance-heavy environments. XLM fits that profile in a way very few digital assets do. Prioritizes transaction finality. It focuses on cross-border settlement. It integrates easily with existing financial rails. Those are not features designed to pump a chart. They're features designed to survive regulatory scrutiny. So when people say BlackRock has a secret plan, what they're really sensing is this quiet alignment between institutional needs and protocol design. No press conference required. Think about how BlackRock operates historically. They didn't make noise about ETFs until the groundwork was already laid. They didn't hype tokenization until regulators were prepared to engage. And they don't publicly champion networks until those networks are already integrated into broader financial conversations. What happens before the headlines is always the most important part. Conversations with regulators, framework discussions, pilot programs that don't make the news. By the time retail hears about something, BlackRock is already thinking about risk management, liquidity access, and long-term exposure. This is why XLM being discussed in institutional circles matters more than price action. Because price reacts to attention, infrastructure reacts to necessity, and necessity is building. Cross-border payments are not optional. Tokenized assets are not theoretical anymore. Interoperability is no longer a nice-to-have. It's required. BlackRock's real strategy isn't about betting on one coin. It's about ensuring that when traditional finance fully intersects with blockchain systems, they are already connected to the rails that move value efficiently and compliantly. XLM doesn't need to dominate headlines to play that role. It just needs to be there when the switch gets flipped. And that's why this moment feels strange. Because nothing looks dramatic yet. But if you understand how institutions move, you realize this phase is where outcomes are decided. Not when prices explode. Not when influencers shout. But when systems quietly align. So the real question isn't whether BlackRock likes XLM. The question is whether global finance can afford to ignore networks built specifically for the problem it's trying to solve. And once you look at it that way, the silence starts to make sense. Because the biggest moves are almost always made before anyone thinks they matter. Once you understand how BlackRock actually operates, the conversation around XLM starts to feel less mysterious and more inevitable. Because BlackRock doesn't chase innovation. They standardize it. That's a critical distinction. Innovation is chaotic. It's experimental. It breaks things. It moves fast and asks questions later. BlackRock doesn't live in that world. They live in the world where innovation has already proven itself enough to be controlled, measured, and deployed at scale. That's where Stellar quietly fits. Think about what BlackRock truly needs in any financial rail it takes seriously. Not hype, not community excitement, not promises of future upgrades. They need predictability. They need clarity around governance. They need consistency in transaction costs. They need networks that don't surprise regulators or counterparties. And above all, they need systems that can plug into existing financial infrastructure without forcing banks to reinvent themselves. This is where XLM separates itself from the crowd. Stellar wasn't built to replace banks. It was built to connect them. That single design choice changes everything. Banks don't want to burn down their systems and start over. They want bridges. They want compatibility. They want tools that let them modernize without destabilizing their balance sheets. From BlackRock's perspective, that matters more than ideological purity. And here's something most retail investors overlook. BlackRock's biggest asset isn't capital. It's trust. Governments trust them. Central banks trust them. Regulators trust them to manage risk responsibly. So when BlackRock explores digital asset infrastructure, they are extremely sensitive to anything that could threaten that trust. Networks that lean into compliance, transparency, and predictable governance don't feel restrictive to BlackRock. They feel safe. And safety is what allows scale. XLM's design philosophy aligns with that mindset almost uncomfortably well. The Stellar network prioritizes transaction finality over experimentation. It focuses on low-cost settlement over yield farming. It emphasizes interoperability over maximalism. Those choices don't excite retail traders, but they speak directly to institutional risk committees. Now zoom out a bit. BlackRock isn't just thinking about payments. They're thinking about the next evolution of asset ownership itself. Tokenized bonds, tokenized funds, tokenized real-world assets. All of these require a settlement layer that can move value across jurisdictions quickly, cheaply, and without introducing unnecessary regulatory friction. If tokenization is the front end, settlement is the back end. And the back end is where things break if the infrastructure isn't solid. XLM was designed with that back end in mind. It doesn't try to be everything. It tries to be dependable. From an institutional standpoint, that's powerful. Because once a system proves dependable, it becomes boring. And boring systems are the ones that last. BlackRock doesn't need Stellar to outperform Bitcoin on a chart. They need it to quietly function in environments where mistakes are unacceptable. Imagine a future where banks are issuing tokenized assets across borders. They need to settle those transactions without delays, without excessive fees, without legal ambiguity. They need rails that regulators already understand. This is why Stellar's long-standing engagement with regulators and financial institutions matters so much. Not because it creates headlines, but because it removes friction. BlackRock's strategy has always been about removing friction between capital and opportunity. When friction is high, capital stays cautious. When friction drops, capital flows. And capital flows don't announce themselves. They move silently. This is also why you don't see BlackRock executives tweeting about XLM. They don't validate networks publicly until after the ecosystem has matured enough to absorb institutional participation without volatility. Public excitement comes later. Infrastructure comes first. So if there is a secret plan, it's not a secret meeting or a hidden partnership. It's a long-term alignment between what institutions need and what Stellar already provides. That alignment doesn't guarantee explosive price action tomorrow. But it does create something far more important: relevance. Because once a network becomes relevant to institutions, it stops being optional. It becomes part of the plumbing. And plumbing isn't flashy, but nothing works without it. This is why the silence around XLM can be misleading. Silence doesn't mean disinterest. Sometimes it means the opposite. It means conversations are happening in rooms where speculation doesn't belong. Rooms filled with risk officers, regulators, and infrastructure architects. BlackRock lives in those rooms, and Stellar speaks that language. Which brings us to the uncomfortable truth for retail investors. By the time institutions talk openly, the positioning phase is usually over. The quiet work is already done. So if you're waiting for BlackRock to loudly announce anything about XLM before taking it seriously, you're probably watching the wrong signals. Because institutional adoption doesn't arrive as hype. It arrives as integration. And integration rarely makes noise until it's unavoidable. That's the stage we're inching toward now. Not excitement, not mania, but quiet alignment. And once that alignment locks in, the narrative around XLM doesn't need to be sold. It simply becomes obvious. Let's take this one layer deeper, because this is where most people lose the plot. Once institutions like BlackRock start aligning with infrastructure-first networks, the next domino isn't price. It's usage. And usage is where everything quietly changes. Banks don't wake up one day and decide to adopt crypto. That's not how it works. They move in phases. Slow ones. Internal pilots, sandbox environments, limited exposure, then eventually production-level integration. What they're really doing in those early phases is stress-testing trust. They ask simple but brutal questions. Will this network still work under heavy load? Will regulators tolerate it across jurisdictions? Will it behave predictably during market stress? Can it integrate with legacy systems without breaking them? These questions don't care about narratives. They don't care about social sentiment. They don't care about price predictions. They care about failure points. And this is where XLM starts to look less like a crypto asset and more like financial infrastructure. Stellar was designed to operate in environments where failure isn't just inconvenient, it's unacceptable. That's why so much of its focus has been on settlement, interoperability, and simplicity. Not because it's boring, but because boring is safe, and safe is scalable. Banks don't want complexity. They already have enough of it. They want rails that do one thing well and don't surprise anyone. When BlackRock evaluates digital rails, they're not thinking about retail excitement. They're thinking about whether this system can support tokenized money, tokenized securities, and cross-border settlements without introducing new risks. That's the real battleground. Because tokenization is no longer theoretical. It's already happening. Funds are being tested on-chain. Real-world assets are being represented digitally. Cross-border settlement is being reimagined. But here's the uncomfortable truth. Tokenization without reliable settlement is just a demo. The value isn't in creating digital assets. The value is in moving them efficiently, compliantly, and globally. That's where Stellar quietly fits into the institutional puzzle. XLM isn't trying to own the asset layer. It's trying to make the movement of value frictionless. That distinction matters, because banks don't need another asset to speculate on. They need infrastructure that reduces cost, time, and risk. And when those incentives line up, behavior changes. Slowly at first, then all at once. Think about how banking actually works today. Nostro and Vostro accounts, delayed settlement, multiple intermediaries, fees stacked on top of fees. Everyone accepts it because there hasn't been a better alternative that regulators are comfortable with. Now imagine a system that can reduce that friction without forcing banks to abandon compliance. That's the kind of upgrade institutions care about. Not disruption. Optimization. BlackRock understands this deeply. They don't invest in revolutions. They invest in transitions. And transitions require bridges, not bombs. This is why XLM's role in institutional conversations often shows up quietly alongside words like efficiency, interoperability, and settlement. Those words don't trend on social media, but they decide which systems get used. Another thing most people miss is timing. Institutions don't wait for perfection. They wait for good enough, combined with regulatory clarity. Once that threshold is crossed, momentum builds quickly. Not because of hype, but because incentives align. If a bank can save time, reduce costs, and remain compliant by using a network like Stellar, that decision eventually becomes unavoidable. Not today, not tomorrow, but eventually. And once one major institution proves it works, others follow. Not because they believe in crypto, but because they believe in efficiency. This is how adoption actually spreads. Quiet pilots, successful tests, incremental rollout, no fireworks, just execution. BlackRock's involvement in digital asset infrastructure signals that this phase is no longer hypothetical. It means institutions are preparing for a world where blockchain-based settlement is normal, not experimental. And when that world arrives, the networks that survive won't be the loudest. They'll be the ones that integrated early, complied early, and focused on reliability instead of attention. XLM checks those boxes in a way that feels almost intentional in hindsight. So if you're watching price charts and wondering why nothing dramatic is happening, you might be asking the wrong question. The real question is whether the rails are being laid. Because once the rails exist, the traffic comes later. And by the time everyone notices the traffic, the infrastructure is already in place. That's the phase we're in now. Not the celebration phase. Not the explosion phase. The preparation phase. And history shows that this phase is where the biggest outcomes are quietly decided. There's a moment in every market cycle where things stop feeling exciting and start feeling deliberate. That's the moment we're in right now. Not the kind of moment that trends. The kind that determines outcomes. When you step back and look at what's happening with BlackRock, banks, and infrastructure-focused networks like XLM, you start to realize this isn't about prediction. It's about positioning. Institutions don't rush toward opportunity. They wait for the ground to stop moving. They wait for rules to solidify. They wait for systems that can support real volume without breaking. And when they move, they don't do it loudly. They do it carefully. That's why this phase can feel confusing for retail investors. There's no clear signal, no explosive announcement, no headline that screams, "This is it." But the absence of noise doesn't mean absence of progress. It often means the opposite. XLM isn't being discussed because it's exciting. It's being discussed because it fits. It fits into compliance-heavy environments. It fits into cross-border settlement needs. It fits into the slow, methodical way banks upgrade infrastructure. And that's uncomfortable if you're used to crypto being fast, chaotic, and speculative. But it's exactly what long-term systems look like when they're being built. BlackRock's influence matters here not because of what they say publicly, but because of how they move privately. They shape frameworks. They advise governments. They help design the rails that capital flows on. When a firm like that takes digital infrastructure seriously, it doesn't mean prices are about to explode tomorrow. It means the foundation is being poured. And foundations don't look impressive until the building starts rising. This is also where patience becomes a real skill. Not blind patience. Informed patience. Understanding that value creation doesn't always show up as price action first. Sometimes it shows up as relevance. As conversations behind closed doors. As integration into pilot programs. As networks being evaluated not for excitement, but for durability. XLM has spent years being underestimated because it didn't chase hype. Now that same restraint is what makes it institutionally attractive. That's not an accident. It's a trade-off. And trade-offs only make sense in hindsight. So if you're holding XLM and feeling like you're early but unsure, that tension is normal. Because you're positioned in a phase where certainty hasn't arrived yet. but direction has. The future BlackRock and banks are preparing for isn't one where crypto replaces finance. It's one where crypto quietly becomes part of it. Invisible to users, boring to speculators, essential to institutions. And when that transition finishes, the networks that survive won't be the ones that shouted the loudest. They'll be the ones that worked when nobody was watching. That's the lens you need right now. Not excitement, perspective. Because by the time clarity becomes obvious, the opportunity usually isn't. If this gave you a clearer way to think beyond price and hype, tap the like button. Subscribe for calm, honest breakdowns of where crypto is actually going. And comment one word that describes how you feel about XLM right now.